The key local data released over the last week was all about jobs, the unemployment rate and also wages growth data. From an employment perspective, the jobs growth was okay with a 10,800 rise, keeping the unemployment rate at 5.7% and employment growth running at 2.1% year on year. Less impressive were the details, with the jobs growth all being part-time employment, and the average hours worked actually fell 1.1%, their third fall in a row. The biggest jobs growth was again in New South Wales and Victoria, but this time a better read from South Australia, which combined well with the recent announcements on investment in the defence industry in Adelaide. Arguably more important than the unemployment rate was the wages growth figure at 2.1% year on year, the slowest growth on record, especially in the private sector where the number was only 1.9%. So no wonder inflation is so low. The minutes from the latest RBA board meeting, where the interest rate cut was agreed, did analyse low wages growth and make the link to the low inflation outlook, which is why the market continues to expect further RBA rate cuts. This, in turn, is keeping the Aussie dollar under pressure, touching 72 cents for the first time since early March. We are still not convinced that the Australian dollar will return to below 70 cents, given the less optimistic outlook in the United States, although most market forecasters are still calling the Aussie lower, partly due to expectations of a US rate hike in June, and with the Australian 10-year government bonds hitting their lowest rate on record at 2.2%, so a lower A dollar may be a natural conclusion. But with our AAA credit rating and the prospect of cheap long-term financing of infrastructure projects, this combination doesn't have to translate to a lower currency. Most likely, it will be developments in China and the United States that determine our fate, and therefore the level of our exchange rate. Until next week, that's the market update from Bendigo Bank.